All right, all right. Good morning. Good morning, all you magnificent melon heads of the world, and happy Tuesday, everybody. Today is March 5th, 2024, and the top story this morning is Target earnings and this magnificent stock movement. Target stock is rallying like the blazes ahead of the open, even though I went through the quarter that they just posted. And I don't know what the heck Target investors are looking at, but it can't be the same quarterly report because that quarterly report, it really sucked. It's another case of stop reading at the headline. As long as you just read the headline and then invest accordingly, you'll be fine. If you actually read the results, listen to the conference call, analyze the numbers, I don't know, do the whole empirical data thing, these numbers really sucked. And, well, let's just get into a little bit. Target saw total comparable sales down 4.4% year over year. Those are not good numbers. When people are spending 4.5% less in your store than they did a year ago, that's a bad thing, okay? You see where we're going with this? Comparable store sales, not the total comps, comparable store sales were down 5.4%. Even worse. Even digital comps, people shopping online, those were down 0.7% year over year. Now, digital sales are almost always positive. They've been positive for like a decade at Target as they cannibalize in-store shopping a little bit. We've seen some pretty good digital growth in the digital comps over the years at Target. But even that was negative. When your digital sales are negative, that is just a terrible number. And the guidance wasn't good either. They're still forecasting a 3 to 5% decline in their comps moving forward. So I don't really know where the good number was. Yes, it was a top line beat by a couple of $1 million. Well, there's inflation. And, also that's being aided by buy now, pay later. People are just buying things that they can't pay for. Worry about that later, I guess. But the big story going on at Target, and shout out to my buddy Frog Capital on X who spotted this one, a 12% drawdown in inventory was buried in that Target number. So if you want to know why Target's earnings were so good, it's because they're selling stuff and then not buying new stuff to replace it because they see the decline in comps. They see how people have no savings left. They see how people are getting desperate, turning to things like buy now, pay later loans and mountains of credit card debt to try to keep buying this stuff. And, well, Target's saying, we're not going to restock the shelves. We're just going to sell down what we've already got. So there was a $1.6 billion decline in Target's inventory in this most recent quarter. That is why Target's earnings were so good. They're just not replacing the stuff that they sell. And while that's not sustainable, that, of course, means once you right-size your inventory, something we've been hearing about for the better part of a year and a half now. We've been hearing about right-sizing our inventory. Oh, we're almost done right-sizing inventory. A return to normal is just around the corner. It ain't here yet. That's for sure, not based on those Target numbers, 12% decline. And we see that in all of these terrible manufacturing PMIs that we've been getting for the same year and a half. They're not ordering the stuff from the factories. And so the PMIs have been terrible. And since the factories aren't making stuff, they're not loading the stuff onto boats and onto trucks. And we're seeing the same thing in all of the logistics data. There's nothing moving on the highways. There's nothing moving on the seas, other than the stuff the Houthis are shooting at, of course. So you're seeing this slowdown across the board, and yet the stock is up almost 10% ahead of the opening bell. Hot damn, if you don't have a beautiful metaphor for this economy in its entirety, all bundled up nice and neat into these Target earnings. Sales are down, inventory's down, nobody's ordering nothing, nobody's buying nothing, and the stock goes higher. Isn't that just the most 2024 headline ever? Gotta love it. A lot of other things going on in the world also today. We had yesterday, New York Community Bank dropped another 23%. Another 23%. That stock's down like 78% year to date at this point. There was a Fitch downgrade late Friday. How did I miss that one? Just caught it this morning. Fitch downgraded New York Community Bank's credit rating and their outlook. And, of course, people just dumped New York Community Bank at the opening yesterday as a result. We've got more problems in commercial real estate, big problems in commercial real estate. These 9-figure losses, buildings losing $100 million plus, This is now a daily occurrence. And these are just the ones that we hear about, just the ones that actually make it to a headline. This stuff is going on all over the world. Today, it's 3 office buildings owned by Paramount Global, the movie studio in San Francisco. It looks like they are getting set to hand those back to the lender. Some big losses on those buildings, hundreds of millions of dollars up in smoke. And across the pond in the Pacific, they're getting in on it too. Check out these numbers from Country Garden that just hit the tape yesterday. 85% year-over-year decline in contracted sales for Country Garden. 85%. There's only 15% less. And I have to add, guys, I feel compelled to point out that we're talking about some pretty lousy comps here, because that's compared to January of 2023. Remember, January of 2023, that was right after the zero COVID lockdown ridiculousness in China. Remember, they were locking people in their factories, welding people in their homes and their buildings. Remember how ridiculous it got at the end of 2022 in China? Well, the total contracted home sales for Country Garden is down 85% from that. That's how bad those numbers are in China. And they just keep getting worse. And China Vanka's over there like, hold my beer, because that's one of the big developers, the Vanka Group. I think they are like the 3rd or the 4th biggest developer left in China. They haven't defaulted yet on their bonds, but it looks like they might be about to, because we've got Chinese insurance companies are starting to warn their investors about credit risks for Vanka, who is claiming they have the money to make a big bond payment that's coming up in a couple of days here, even though they're currently negotiating for more time with the people they owe the money to. So that's the next one, I guess, that we need to worry about is China Vanka. Also, some more stuff coming out of China with Apple and Tesla. These are big. China's iPhone sales in the first 6 weeks of 2024 are down 24% versus a year ago. Again, those are some really bad comps we're talking about here. The first 6 weeks of 2023, remember, the China reopening, it's going to be so wonderful. Nope, it was a dud. Well, we are down 24% from that. Now total iPhone sales in China are down total smartphone sales in China are down 7%, but iPhone sales are down 24%. So within the greater secular decline, you've got a massive decline in Apple. I think you got a few things going on there. Number one, the iPhone 15 was a dud. There was no innovation. There was nothing new or cool about it. Oh, yay, we threw another camera on there. What do we have, 25 cameras on an iPhone now? Great. The 25th camera didn't really add any value, and it didn't make people turn out. I think you've also got a little bit of, whether it's anti-American sentiment or pro-Chinese sentiment, whatever it is, that the Chinese consumer is being driven to buy locally, driven to buy China-produced. So that is also contributing to Apple's decline in iPhone sales. And I think that's also showing up in Tesla's numbers too. Tesla stock was down big yesterday because we got some disappointing numbers on shipments from the Shanghai Gigafactory. Just 60,300 Teslas were produced at the China Gigafactory in the last month. That is just barely higher than the worst numbers, the December of 2022 numbers. Again, peak COVID numbers. Just a few hundred vehicles higher than that. And that's despite price cuts on Teslas in China. And then yesterday, they even rolled out some new incentives that amount to basically like almost another $4,000 price cuts with these incentives that are offering. So again, you've got a secular decline in electric vehicles within a secular decline in all vehicles. But at the same time, you've got this, I think, anti-American, pro-Chinese sentiment that's fostering over there, right? Look, we get the same thing here. So I'm not knocking them for it. You know, you cheer for the home team. That's just how it works. But that's taking a big chunk out of Tesla today. So much going on in the world. I don't even know where to begin today. Why don't we just shrink my melon of a head and let's see what's going on? Guys, don't forget, hit that like button. It really helps with the YouTube algorithm. And if you're new to the channel, hit that subscribe button and notification bell and have your coffee with the Melon Heads every morning while we go through markets. The S&P 500 is down 21 points ahead of the opening bell. That is negative 0.4%. The Dow is down 140 or 0.36% lower ahead of the open. Looks like it's heading even lower still. Got some downward momentum this morning. But the NASDAQ is leading the way lower, down 0.62%. 113 points lower on the NASDAQ this morning. I'm sure Tesla's contributing to that. We've even got SMCI is down for a change. I don't know why that one is down, but Stocks are heading lower this morning pretty much across the board. We've got a modestly stronger dollar here, up by 3 basis points at 103.86. But the Dixie is not really playing a role in stock prices this morning, at least. And then looking over at the yield curve, it looks like we got some people moving to safety on the long end of the yield curve this morning. This is kind of curious here. 30-year Treasury is down 6 basis points. Remember, when you see yields going down, that is bond prices going higher. So we've got people are bidding up the prices on the long end of the yield curve this morning. 30 years at 4.295. The 10 years at 4.159. That's down 6 basis points. The 2-year, 4.572. That's down 3.5 basis points. But the 1 month is at 5.387. That's up a point and change. Looking over at the commodities board, again, it looks like a little bit of a flight to safety going on because gold is getting in on it too. April gold futures, $2,137. We were as high as $2,150. Is that an all-time high for gold futures? It's dang close if it isn't. Up $10 this morning, or about 0.5%. May silver futures also getting in on it, 24.21, up 22 cents or 0.92% higher for silver. So both shinies looking pretty good this morning. Platinum, though, down almost 2%. Palladium's down almost 3%. So the PGM metals not liking this as much. And April crude oil futures for West Texas Intermediate, $78.34. That's down about 40 cents this morning, or about 0.5 point lower. And Bitcoin continues. Excuse me. Sorry, guys, got a frog in my throat. Bitcoin continuing its run this morning. Showing it down a couple $100 here, showing down $800, but really 67,545, higher than we were at this point yesterday. Bitcoin needs a breather. It just seems to be making new highs. We're not quite at an all-time high here in Bitcoin. I believe 68,000 was the all-time high. Looks like we just touched 69,000 back in November of 2021. That's a level we're probably going to break through in short order here if this continues, this run here. Bitcoin just going parabolic here. The BlackRock Bitcoin ETF is now over $10 billion in assets, setting records for the rate at which cash is flowing into that Bitcoin ETF. So ETFs still in the driver's seat when it comes to Bitcoin prices, and we haven't even had that halving yet. So it looks like we're going to be talking probably a lot about Bitcoin in the months ahead, folks. Get ready for that one. I know some of you guys react a little passionately to the subject of Bitcoin on this channel. But let's talk about the elephant in the room this morning. Target shares pop as retailer boosts profits despite lackluster sales forecast. And this one really got me scratching my head this morning. Target on Tuesday posted holiday quarter revenue and earnings that topped Wall Street expectations. They always do, of course. But the company said it expects another year of weak sales. Even so, Target's comparable sales declined for the third quarter in a row, 3 quarters in a row of negative comps. The key metric, which includes digital sales, takes out the impact of store openings, closures, and renovations, fell by 4.4% in the fiscal fourth quarter. That number is terrible. Target doesn't anticipate sales will bounce back quickly either. For the current quarter, Target is expected to see comparable sales to drop by between 3% and 5%, and adjusted earnings per share to come in from 170 to 210. That is lower guidance than the market was expecting. Again, I don't know why this stock is rallying this morning. The guidance is not good. The earnings, yeah, it was a beat, but it was driven all by inventory reduction. I don't know what the market sees in this report. The company said it expects full year 2024 comparable sales to be flat to up 2% and adjusted earnings per share to range from 860 to 960. Yet Target stressed its progress after a rough stretch marked by lower discretionary spending. Store and website traffic, while still down year over year, improved for the second quarter in a row. Profits jumped as the company's better managed inventory and benefited from falling supply chain, freight, and e-commerce fulfillment costs, and an emphasis on lower price points resonated with shoppers. So it's possible that those last few sentences there, maybe that's why we're doing so well, because Target's margins did look really good in this quarter. Again, margins are easy to look good when you don't buy the stuff, or when you don't replace the stuff you sell. It's easy to have good margins, right? Profits jumped on better inventory, i.e. not replacing the stuff they sell. Falling supply chain, freight, and e-commerce costs. It's just cheaper to move things by truck and by boat because they're not as busy anymore. So that's helping their margins a little bit. So I guess that could partially explain why Target is doing okay this morning, but not as well as it's doing. And shout out to Frog Capital on X. I've been following him for a while. He does really good analysis on these corporate earnings, and he caught this one. Let's bring the image up. I don't know if you guys can see it. I can't really make it much bigger, but he's got the inventory numbers highlighted. In January of 2023, the inventory was $13.499 billion, and on February 3rd, it was $11.886 billion. That is a decline in inventory of $1.6 billion. Almost the entirety of Target's earnings in this most recent quarter could be attributed to just the inventory they haven't replaced in the last year. I know we're talking quarterly versus annual there. But this is a huge reduction. You're talking a 12% drawdown in inventory, $1.6 billion worth of stuff that they sold and didn't replace. Of course their margins look good. Of course their earnings look good. They're not replacing the stuff they sell. And the reason why they're not replacing the stuff they sell is because they know things are not about to get better. Things are going to get worse. If they thought things were going to be getting worse or were going to be getting better, then they'd be expanding their inventory. They'd be buying more stuff so they had more stuff to sell. But Target investors this morning are just loving life. It's up 7.7% ahead of the opening bell. The stock was up almost 10%. Okay, now it is up 9.7%. So Target just having a blowout morning. Be careful with that one, guys. Again, there's not good things on the horizon for this company. Looking over at this one, again, shifting gears to commercial real estate here. Paramount prepares to lose 3 office buildings in San Francisco. And this one is in the Real Deal this morning. Properties are in workout mode, the CEO says, significantly below their debt. Not things you want to hear when talking about $700 million office projects. Paramount Group appears poised to surrender 3 office buildings in downtown San Francisco after defaulting on at least one loan. The New York-based investor has written down to zero a 293,000 square foot tower at 111 Sutter Street and the 2-tower, 750,000 square foot Market Center at 555 and 575 Market Street. That's in the financial district of San Francisco. So they are writing down the value to zero. It means all the money they put down when they bought it, all the equity they had in these buildings, it's gone. The buildings are worth less than they owe on them. Paramount bought the century-old Hunter Doolin building at 111 Sutter with partner Harbor Group International in early 2019 for $227 million or $775 a square foot. The lender was Mesa West Capital. That's a real estate investment firm out west. Later that year, the firm and an unidentified partner bought the 22 and 40-story Market Center for $722 million or $960 a square foot. The lender was ING. Guys, these are 2019 values. We're not talking about 30 years ago they bought it for this. This is just 5 years ago. They bought these buildings for almost $1 billion combined, and right now they are writing down the value to zero. Later that year, the firm, these 2 assets are in workout mode. Paramount CEO Albert Beller told analysts on a February 15th earnings call, "We do not know what an ultimate resolution will look like, and there's a strong possibility that these assets may not be in the Paramount portfolio going forward." That means they're getting ready to hand the keys back to the lenders and walk away from the buildings for nothing, which they're allowed to do with commercial real estate because they're non-recourse loans. And the only thing the lenders can do is just take the building back. They can't go after Paramount's other assets. At the end of 2022, Paramount wrote its investment in the 25-story building at 111 Sutter Street down to zero. It then defaulted on its loan for the property before negotiating a cash flow loan through which the company does not have to use any of its own capital for loan service. So these 3 buildings, they are in default and they're about to go back to the lenders. But it's not just U.S. commercial real estate this morning, guys. It's also happening in China. Country Garden reports major slump in China home sales, triggering fresh alarm for creditors amid debt restructuring. These numbers are horrendous. Country Garden Holdings said home sales plunged last month to a multi-year low, raising fresh alarm about its financial distress, even as the mainland Chinese developer fends off hostile creditors in Hong Kong and seeks forbearance on more than $10 billion in offshore debt. That $10 billion number, that's just the offshore debt. They've got hundreds of billions of dollars in total debt. This is just the dollar-denominated stuff we're talking about here. The firm, once China's biggest home builder by sales, reported just 3.72 billion yuan, or about $516 million US, in contracted sales for February. That is an 85% slump from a year earlier. It said in a Hong Kong Stock Exchange filing late Monday. Sales fell 32% from 5.49 billion in January. And holy smokes, if you think 85% year over year is bad, 32% decline month over month. And that's just down from where they were in January. Where they were in January was already way down from where they were a year ago. This thing is not slowing. There is not a bottom just around the corner in the Chinese housing market, guys. It is getting worse. It is getting worse faster. It's falling. It's still accelerating. It just hasn't hit the ground yet. They haven't gone splat at the end of the fall. It's the guy who jumps out of a 20-story building, and after falling 19 floors, he looks to the guy next to him and he says, "So far, so good." Well, not going to work that way at the end there. The February slump is the steepest in at least 5 years and amounted to about a tenth of Country Garden's average monthly sales of 35 billion yuan over the past 4 years, according to its filing records. And it's not just Country Garden, guys. Now we're talking about Vanke this morning. Shout out to my buddy Nashville Pasta Man who sent me this one on X. Chinese insurers sound the alarm over Vanke debt risks after property giants' bonds and shares tumble on repayment concerns. Some of China's largest insurers are sounding the alarm over the debt risks of China's Vanke, according to people familiar with the matter, as shares and bonds of the firm, a major property developer, hit record lows on repayment concerns. At least two Beijing-based insurers that farmed out annuity investments last week told their external portfolio managers to closely monitor Vanke's credit risks. One life insurer also told its pension managers to curb exposure. So you've got pensions and you've got insurance companies are both worried about repayment of Vanke's debt. That sounds an awful lot like Contagion, right? It's not just who Vanke owes money to, but the people Vanke owes money to. Who do they owe money to? Well, they owe money to people who own insurance policies or people who own these pensions. So now they're starting to get worried about the knock-on effects, the contagion risk of all of these developers not paying their bills. Monday's decline across the board were fueled by recent reports that the company is negotiating with lenders to delay payments, the latest cause of concern for its repayment abilities. In December, at least two state-backed Chinese insurers agreed to give Vanke more room on private debt payment, Bloomberg reported. And coming back to the U.S., that commercial real estate bubble was back in the news on Friday afternoon when Fitch downgraded New York Community Bancorp and their outlook to negative. I missed this one Friday afternoon, but this was a big one. And this downgrade from Fitch sent New York Community Bank stock tumbling yesterday, falling more than 23% just yesterday to $2.73 a share. This was a $10 stock a month ago, guys. This thing is getting crushed here. Now it's up a little bit. It's up a nickel pre-market right now, 2% higher. This thing is going to be an FDIC receivership soon. I don't know when. I don't know if it's going to be at the end of the week. I thought it was going to happen last Friday. It didn't. There's only so much beating a bank can take before the FDIC just steps in and says, you guys are insolvent, and they seize you. So keep an eye on this one. Sooner or later, we're going to get that announcement. Stock can only fall so far. It makes it harder for the company to borrow money to remain solvent. They can't issue shares, not when the shares are only worth $2 each. It's hard for them to borrow when their credit rating is getting downgraded. So this bank is in big, big trouble. Now back to China. I know we're jumping around the world this morning. This is a big one. Apple iPhone sales slumped 24% in China to start the year, according to a report. This one just hit the tape this morning at 6 a.m. Eastern time. Let's see. China smartphone sales were down 7% in the first 6 weeks of 2024 compared with the same period last year, as customers showed a lack of interest in Apple's newly launched iPhone 15 and instead turned toward devices made by Chinese manufacturer Huawei. New figures from Counterpoint Research showed Apple's smartphone unit sales fell 24% in just the first 6 weeks of 2024, as Chinese customers held on to earlier models instead of going out to buy the iPhone 15, which costs $833 in China, or about 6,000 yuan. So 7% decline in total smartphone sales. So the whole sector is falling, but iPhone down 24%. That means Huawei is eating Apple's lunch right now in China. Apple stock is down 2.5% ahead of the opening bell this morning. That's after being down 2.5% yesterday on the news of that big antitrust fine from the European Union around how they handle the App Store and music streaming services. So Apple's had 2 bad days in a row. Shares currently trading at $170.75. And Tesla's got some bad news coming out of China also. Tesla stock tumbled 7% as shipments slump and new price cuts were announced in China. This one happened yesterday. Tesla shares dropped to new multi-week lows as slowing China shipments and new price cuts there hint at troubles for the EV stalwart in the world's largest car market. Tesla reported 60,365 vehicle shipments from its Giga Shanghai factory in February, according to preliminary data from China's PCA. The February shipments represent a 16% drop from a month ago, a 19% drop from a year ago, and the lowest shipment total since December of 2022. Now, guys, let's take a look at the shipments in December of 2022. Here's the monthly shipments going on from China's from Tesla's Shanghai Gigafactory. Now, you can see here, these were the lowest numbers all year. The only one that came in lower was that December of 22 number. Remember, guys, that was peak zero COVID. They were locking people in the factory. Nobody was allowed to go anywhere, do anything. So, of course, they're making slightly more than that, but only a few hundred vehicles more. I think it was like 58,900 vehicles they made in December of 2022 versus 60,300. Terrible numbers for Tesla in China. And it wasn't just the lower production numbers. According to this report from Deutsche Bank, Tesla's latest incentives on the mainland include the equivalent of about $4,800 in price cuts to customers who purchase from existing inventories of Model 3 and Model Y vehicles by the end of March. The new incentives include insurance discounts, discounts on paint changes, preferential financing plans on the Model Y. And these latest incentives come after Tesla cut prices in January for the Model 3 and the Model Y by 5.9% and 2.8% respectively. So price cuts in January, new incentives in February amounting to almost $5,000 per car, and lower production numbers. Tesla is in big trouble in China. And yesterday, the stock price reflected it. Tesla fell 7.16% yesterday. It's down another 2.77% this morning, trading at $182.96 ahead of the opening bell. So much going on in this world. A lot happening today. Bad news in China, bad news in the States, bad news in commercial real estate. New York Community Bank is on the ropes. A lot going on in this world this morning. And thank you, Brett Green, who says low short floats on the tech stocks makes me think that this market still has legs. Look, I don't know what is going on in the options market right now, Brett. The zero DTE options, everybody just YOLOing in the calls. It's going to work until it doesn't, okay? When things go parabolic like this, the end is usually sudden and it is bloody. It can go higher. It might still have legs. I think NVIDIA stock is probably on autopilot to $1,000. Why? Just because all these guys who think they're analysts got together and said, wouldn't it be cool if NVIDIA was worth $1,000? Awesome, bro. Let's go make it happen. But it's going to get there and it's going to stall like an airplane, and it's just going to go into a dive, and they better be able to pull out of that dive before they hit the ground. So does the market still have legs? Maybe. I mean, does it still have wings? I mean, is it still buoyant? Because this market isn't running. This market is floating. This market is Wile E. Coyote that walked off the cliff and doesn't realize it's standing on thin air. And then eventually it's going to look down. It's going to hold up the sign that says, help me. And it's going to plummet right out of the sky and disappear, exit stage lower, whatever you call it. So does it still have legs? Could it go higher? Sure. Bubbles are funny like that. Manias are funny like that. I'm not trying to short it. I'm not trying to call the top because that's a good way to get your head handed to you. But it's obscene, and look no further than what Target stock is doing. Those numbers from Target were just awful this morning, and the stock is up almost double digits on that news. And they're telling us in their guidance, it's not getting better. It's not going to get better. It's going to get worse first. And everybody's like, oh, they said growth. They have a new membership program. Quick, buy their stock. Good luck. Good luck with that, guys. Thank you very much, Brett Green. Appreciate the super chat support of the channel, sir. And thank you, Alex Lieberman, who gifted 20 Nobody Special Finance memberships. Thank you, Alex. I appreciate that. And if you are the recipient of one of those memberships, be sure and send a thank you to Mr. Lieberman. Thank you, Alex. You are a gentleman and a scholar, sir. I appreciate that very much. And thank you, everybody, for having your coffee with the Melonheads this morning. I appreciate that very much. Thank you guys for the super chats. And thank you to my Patreon supporters for everything you guys do for the channel. Links down below in the description to all that good stuff. Hi, Mom. Hi, Dad. I love you guys. Till next time, live small and dream big.